In recent days, the shine on private credit has come off after some people have had trouble getting their money out.
Imagine a massive vault holding $26 billion of investor money slamming shut. If this vault stays locked, the companies you buy from could go bankrupt overnight.
Shares of KKR and Blue Owl were down as much as 10% yesterday.
This is the story of the $3 trillion private credit crisis. After the 2008 crash, U.S. regulators forced banks to stop making risky corporate loans. Thousands of businesses still desperately needed cash to survive. Private credit filled this massive gap. It was like a private pawn shop for giant corporations. Non-bank lenders negotiate custom, secret deals directly with companies. This market now worth around $3 trillion globally. For context, the 2007 U.S. subprime mortgage market was only $1.3 trillion. To get higher returns, these funds lent massive amounts to mid-sized U.S. businesses. They targeted massive returns, sometimes in the double digits, and they convinced investors it was safe because these loans sit at the very top of the bankruptcy line. If a company dies, the private credit lender gets paid first. But there is a catch. Most of these loans have floating interest rates, meaning borrowers' interest amount depends on Fed's interest rates. Most of those loans were sold when interest rates were very low. When the U.S. Federal Reserve hiked interest rates, borrowers suddenly had to pay much more. This exact nightmare is unfolding in the U.S. right now. A huge chunk of U.S. private credit-funded mid-sized legacy software companies. Now, AI is doing the exact jobs these software companies used to sell. Their profits are vanishing, and they cannot afford their floating rate loans. Because of this, the U.S. private credit default rate hit a record 9.2% in 2025. Lenders face massive exposure to the losing side of AI disruption. They earn no extra profits if a company succeeds, but they lose everything if it fails. But why are giants like BlackRock trapping regular investor money? Wall Street sold these funds to everyday investors as semi-liquid accounts. They promised you could withdraw your cash easily, but they hid a brutal lock in the fine print. If everyone panics, the fund does not pay the first people in line. They chop up the available cash and give everyone a tiny fraction. Just recently, investors asked BlackRock's massive credit fund for $1.2 billion back. BlackRock capped it at 5%, meaning investors only got about half of what they requested. Two massive structural problems make this crisis much worse globally. First, over 30% of these deals are covenant-light loans. These loans have zero protective conditions. Lenders only discover trouble when the company bank account sits entirely empty. Second is total opacity. Funds grade their own homework and value failing loans at full price. Now, U.S. banks face up to $300 billion in exposure to these funds. But how does a U.S. credit crisis affect markets here in India? While private credit in India is a brand new, growing market, we are highly vulnerable. Indian startups and mid-sized firms heavily rely on global private capital. If U.S. funds collapse and freeze redemptions, foreign money flowing into India dries up instantly. Indian banks would face massive pressure to cover the corporate funding gap. Private credit grew into a $3 trillion giant globally by lending where banks would not. If this system breaks, the global freeze will hit the Indian economy directly. Check your portfolios for hidden private credit exposure. Protect your cash, and I will see you in the next video.